Welcome back to Stock Spotlight. I'm your host, Michael. Today, we're breaking down Intercontinental Exchange, ticker symbol ICE. Most people associate ICE with the New York Stock Exchange, but the business is far broader. ICE operates global exchanges across energy, rates, and equities, runs clearinghouses at the center of financial risk management, sells high margin data and connectivity services, and owns a scaled mortgage workflow platform. A central theme in today's discussion is better understanding what clearing and collateral actually mean for financial exchanges. We didn't fully unpack this with Shivam on the episode, but it's worth noting that clearing and collateral are core to the exchange model, particularly for CME, still very important for ICE, though less dominant today, and more limited for Cboe. These three were the ones that stood out most to me across the space. Since we last spoke, Shivam has launched his own investment firm, Night Vision Capital. I'm excited to have him back to dive into the structure and economics of ICE. Quick disclosure, both of us own shares of ICE, and this is for informational purposes only, not investment advice. Welcome to the podcast, Shivam. Before we get into the nitty-gritty, let's start simple. What exactly is Intercontinental Exchange today, beyond just owning the New York Stock Exchange?
So I'm going to use the word ICE as a substitute for Intercontinental Exchange for most of this podcast, just before we get into it. Now, most people think of the New York Stock Exchange when they think of ICE, but there's so much more than that. They also operate major exchanges for oil, such as Brent and WTI, natural gas, power, futures markets, and derivatives as well. They sell trading access, listing services for IPOs and stocks, clearing services. They have index benchmarks, bond data, mortgage software, and financial connectivity between firms as well.
Yeah, they really are a diversified business. Which segments drive the majority of revenue and profitability today?
The exchange, clearing, and data segments drive most of the revenue and earnings today. Their mortgage business does contribute, but it is a cyclical business segment. The exchange and clearing segments, however, are the largest and most profitable. They have stable operating margins at 74%. The data segment has operating margins at 44%, with 83% of revenues being recurring. And they provide ICE with stability and some healthy diversification as well.
Yeah, it really does seem like they have a high quality revenue base. And could you break down that recurring revenue percentage a little bit more for us and tell us where it stems from?
ICE has a healthy mix of both recurring and transaction revenues across each business segment, although some may have higher amounts versus others. In the aggregate, 51% of ICE's revenue is recurring. However, if we break it down, in exchange, 28% of revenue is recurring. In the data business, it's 83%. In the mortgage business, it's 73%. The recurring revenues from both the data and the mortgage components help provide stability, given that the exchange business is highly sensitive to trading volume.
And one area where I think these exchanges really differentiate and where the moat becomes more structural is through clearing and collateral. Let's unpack that next because I think it's often misunderstood. First, can you explain why clearing exists and ICE's role as a central counterparty?
Sure. So clearing is similar to escrow in real estate. When two parties are making a trade, a middleman holds the assets, which would be ICE in this case. They ensure that both parties perform their duties and guarantee the transaction. Clearinghouses collect margin, which is also known as collateral. They have this to absorb any losses, and they help to prevent a system wide financial collapse. Without a clearinghouse, every firm would need a separate credit agreement with every other firm that they do business with. This would make risk management costly and extremely inefficient.
And then can you next walk us through the balance sheet nuance of collateral? I know it's shown as both an asset and liability, and then why those balances are not corporate liquidity.
Yeah, let's make one important point though. ICE doesn't own the collateral. It belongs to the investors, and then the balance sheet shows it under both the assets and the liabilities side. ICE holds these funds in segregated accounts as protection, and they earn clearing fees on these funds. Now, Collateral balances do appear large at face value, but we have to consider the dollar amount of exposure ICE's clearinghouses have. ICE has clearinghouses across derivatives, futures, swaps, and soon treasuries as well. So the amount of exposure here could be in the trillions of dollars, and even a small percentage of that can be a large amount. So ICE's clearinghouses are designed to survive oil price shocks, interest rate fluctuations, among a bunch of other situations that can occur in the financial markets. Just recently, we had a huge spike in volatility for oil prices due to all the tensions going on in the Middle East. Situations like that alone create higher collateral requirements.
Yeah, and I think that makes a lot of sense. And for listeners, if they do view the YouTube slides, you can see we've got a chart on their clearing collateral over the last, I think, 10 years or so. And you'll notice that peak in 2021 and 2022 due to energy and rates activity and volatility as well. So if the economics are favorable, the natural question then becomes what protects it? So tell us a little bit now about the sources of ICE's moat and how does that differ from other competitors, potentially like CME, Cboe, and Nasdaq?
So, regarding the moat aspect, ICE has two characteristics that create it and protect it. They're liquidity and regulation. Liquidity is the stronger moat given that traders generally go where liquidity exists, and it's also less susceptible to disruption risk. In that sense, liquidity begets more liquidity and it reinforces ICE's network effect. Even if fees are lower with a competitor, poor liquidity can increase other costs for traders. This would allow ICE to scale efficiently and is one of the main reasons why it's hard to compete with them. Another thing to consider is that once a firm connects to ICE's ecosystem, they become part of a feedback loop where they use ICE's data to trade, and then that activity creates more data itself. This creates another network effect and switching costs at the same time, since firms become increasingly reliant on this data. The regulatory moat, on the other hand, is powerful as well. However, it comes with some policy risks. Regulations can change, as we all know. They can also increase ICE's own compliance costs as well. However, on the flip side, they also create higher barriers to entry for competitors, and they can drive further demand for ICE, either for their clearing business or even their mortgage component as well. For example, the SEC recently approved ICE to clear treasuries. This will drive additional growth for ICE's clearinghouse and further reinforce their moat. Regarding CME, Cboe, and Nasdaq as well, let's take them one by one. CME dominates US interest rate futures, while ICE dominates global energy futures. So, direct competition is actually very limited between these two since they both dominate different asset classes. Cboe focuses on the VIX, on equities and options, while ICE is a bit more diversified across other asset classes. They do have some overlap between each other, but in general, they focus on different things. The NASDAQ is primarily for tech companies and growth companies, while ICE is mainly for industrial companies, clearing, derivatives, and energy trading. So their moats are dominating different asset classes as well. So in the aggregate, essentially what I'm saying is that ICE's moat differs from all of these companies in that they all dominate completely different asset classes. So they may be in the same sector. However, competition is not as simple as it may appear at face value.
Yeah, I think that's a great way to look at it. And one other potential competitor I'd love to get your thoughts on is, and for those that view the YouTube slides too, you'll see I've got some articles around it, but this Texas Stock Exchange initiative, do you see any competitive risk there in terms of their listings or trading business?
When looking at new exchange threats, we have to understand something really fundamental to the sector. Exchanges are liquidity businesses. So another company can't just compete by doing something as simple as offering lower fees or building a nicer platform. They have to attract liquidity and they have to build the credibility to maintain that liquidity as well. So new entrants struggle with this because the network effects of companies like ICE are established, their benchmarks are entrenched, and regulatory complexity increases natural barriers. Also, trust can take decades to build. Sure, new entrants could succeed against ICE if they're focused on niche markets with regulatory protection. They could even have lower costs. They could have new asset classes that they create, and they could even just find other sources of competitive advantages against them. However, displacing ICE's core markets will still be very difficult.
Yeah, I agree. And when you think about the future, right now, they have three business segments with exchanges around two-thirds of revenue and fixed income and data, and then mortgage tech around 17 to 20% each. Which segment do you kind of think is going to be the growth engine going forward? And are there any segments where you're worried about any weakness or risk?
I expect the energy segment of their exchange business to drive the most growth going forward, specifically Brent crude oil. They have the most liquid global futures benchmark in the world, which is attractive to many producers that want to hedge their production. They have the only Canadian crude futures market, for example. They have two leading Middle Eastern benchmarks. They have the ICE Murban and the ICE Dubai, and the only physically deliverable contracts in Houston as well. So, due to the tensions going on with Venezuela, Russia, and now the Iran related issues, investors are incentivized to use highly liquid contracts to trade given the volatility spikes we're experiencing. So, as tensions continue, trading volumes could continue to grow. Now, we may see weakness in the mortgage business given that lenders negotiated lower minimum volume contracts when mortgage volumes went down a few years ago. In the most recent earnings call, CFO Warren Gardner stated that most of these headwinds should be gone by 2027. However, those headwinds may be offset given that they currently have 4 million loans that are 75 basis points in the money. If rates drop 25 basis points, that number goes up to 5.5 million. And if rates drop 50 basis points, it goes up to almost 8 million. The current administration has also mentioned that they're exploring other ways to stimulate housing demand. So that can also potentially offset this headwind.
Let's get into now, I guess, a little bit around Q4. And I thought management had, I guess, two things that I want to ask you about that were interesting. The first is that they highlighted 99% plus listing retention and recent high profile transfers. How economically and strategically meaningful do you think these listing migrations are?
Walmart moving their listing from the New York Stock Exchange to the Nasdaq was pretty big news a few months ago, so we'll take it in that context. It sounds dramatic, but it's less impactful than it appears. As management reiterated, ICE's retention rate is still above 99%. Also, listings are generally sticky and exchange switching happens from time to time, but mass migrations are extremely rare. Also, in the case of Walmart itself, since the NASDAQ is historically tech focused and the New York Stock Exchange is historically industrial focused, branding may be a likely reason for this migration, just given how Walmart is appearing to market itself.
Yeah, and the Walmart one's a great example. And then also for listeners too, there was another one actually on the positive for ICE in January of 26, where AstraZeneca delisted from Nasdaq and joined the New York Stock Exchange. And I think there was a Reuters article with the big flashy headline, but then reading the actual or listening to the earnings call and hearing that 99% retention, there's a lot of big headlines, but it doesn't seem like, to your point, there's mass migrations really across both. One other thing I thought even more interesting that I did see a little bit of even commentary on X about, and I think this is an area that is just really interesting to talk about, that the CEO of ICE seems interested in, and that's seeking regulatory approval for tokenizing New York Stock Exchange listed securities. Do you view this as like an incremental innovation? Could there be a long-term evolution of exchange and clearing infrastructure?
I think that it could represent both an incremental innovation, but also a longer term evolution as well. In the short term, tokenization will boost operational efficiency by reducing settlement times for transactions. However, over the long term, this could change the entire financial market infrastructure if more institutions begin to adopt it. It could create faster settlement times and allow for 24/7 trading across the entire ecosystem, and ICE would be the one ahead of the curve.
The next layer I'd like to talk about then is management. Who runs Intercontinental Exchange? Tell us about the CEO and how's the insider ownership looking?
So the CEO and chairman and founder of ICE is Jeff Sprecher. He founded ICE back in 2000 for the purpose of creating an electronic market for energy trading. Under his leadership, ICE expanded into a global exchange and financial infrastructure company through acquisitions such as the New York Stock Exchange, Interactive Data, and Black Knight as well. Other key persons at the company are Warren Gardner, the CFO, and Benjamin Jackson, the president. Insiders own 1% of the company in total, while institutions and retail investors own the rest. However, it is important to note that although Sprecher's stake in ICE appears small on a percentage basis, it is worth around $700 million. His total net worth is estimated to be $1.2 billion, so he has significant skin in the game, even though the percentage may look low.
How disciplined have they been with M&A and capital deployment historically?
Management generally focuses on buying assets that expand their ecosystem and can be integrated easily to generate cost synergies. For example, they recently integrated the Black Knight mortgage platform. They originally projected to save $200 million in expenses post integration, but they actually exceeded that target by 15% and saved $230 million. As they continue to integrate it into their ecosystem, they're now expecting $275 million in annual cost savings by 2028. This example alone shows that they're disciplined with M&A in that they focus on what creates overall value for the business itself, and then they maintain that discipline when it comes to generating operating efficiencies as well. In their most recent earnings call, management stated that ICE is a middleman. They don't try to predict outcomes. They simply focus on acquiring and operating the systems that allow capital to move efficiently. That's basically their rubric as to how they view M&A in a few sentences. And after they fulfill any M&A priorities, they use the rest of their excess cash to reduce leverage and return capital to shareholders via buybacks and dividends.
Yeah, and I think they have one of the most beautiful total distribution to shareholder charts that I've created. And that's just simply buybacks plus dividends divided by free cash flow as a percentage. And I really like to have a threshold of below 100% over the long term. And they've been between around 27% and 86% over the last 10 years, never even getting to 100%. So I think this also supports perhaps why Morningstar gives them that exemplary rating, which only 16% of companies had in 2025. So that's very impressive there. Anything investors should think about in terms of SBC, stock-based compensation, or leverage, or any financial statement considerations with ICE?
There is some stock based compensation. However, it is pretty modest compared to other tech companies. I'm personally not too concerned about their SBCs given that they're only around 5% of operating cash flow. However, it is something that I continue to monitor. When it comes to leverage, ICE does use it for M&A. However, because many parts of their revenue streams are stable and they consistently generate free cash flow, they can manage their leverage effectively, in my opinion, and they've shown that historically as well. For example, they reduced their leverage ratio from 3.3 to 3 in 2025. However, given the extensive use of leverage, though, investors should monitor its evolution and study how ICE manages it over time. One other thing investors should be cognizant of is their collateral balance. As we discussed earlier, some of their deposits are sensitive to interest rates, so rate fluctuations can affect their income on these balances. This isn't a core profit driver for the business, but it does have some influence.
That's a great point. And ultimately, this all funnels into one question that I'm sure a lot of listeners are thinking about or wondering is how then do you actually value a business like this? I've seen different approaches like a traditional DCF or reverse DCF. I've seen people use a yield based approach, trading multiples, even price to book, I've heard recommended for exchanges. How do you kind of view valuing a business like this?
I value ICE using multiples of earnings. It's a very predictable business, so we can keep things pretty simple here. We don't have to get too fancy with it. What I did was apply a growth rate to EPS over the next 3 to 5 years. When I first valued the business, 11% is what I used. And then I analyzed its CAGR potential using different multiples. I used an ending multiple of 20 times, and got a return of around 11%, assuming a 0 multiple expansion. So I was comfortable taking a position at that valuation because I believe ICE could potentially trade above 22 times earnings due to its quality and durability. One thing to keep in mind, however, is that this isn't a company to own for ultra high growth like one would expect with the Mag 7. It's a company to own for long term, consistent compounding over decades.
Yeah, I think you hit on a couple good points there. That last one around, it's kind of how I view my portfolio too, of a lot of it is resilient compounders with a little bit of optionality, maybe a little higher growth potential. And then what you also mentioned too is no matter how you value this company, because it is such a consistent business model and the revenue is so stable, that multiples do work really well here. So you don't have to get, as you said, too fancy with the valuation. We'll end on one last question. And I want to ask you, is there anything else about ICE that you think investors often overlook or misunderstand that is important to highlight before we close out here?
I think we covered most of it, but there are a few things worth mentioning here. The founder and CEO, Jeff Sprecher, works hard to maintain an innovative and disruptive culture, which is very important to a business like this. They have a policy where nobody will get fired for trying something new, failing, and then admitting and learning from it. In fact, in a recent interview at the Rotary Club in Atlanta, Sprecher stated that if he could retire and do anything he wanted to, he would want to make a watch that can stand the test of time. This is a sign of his focus on building something sustainable over the long term, which I believe is what ICE represents. One of the signs of this durability is that ICE has consistently grown revenue and EPS in each of the past 20 years and has grown free cash flow in 17 of the last 20 years.
That's very impressive and something that I think very few companies can tout. Well, thank you again, Shivam. We've really enjoyed your time today. And until the next one.
Absolutely. It's a pleasure to be here. Thanks for having me, Michael.
If you enjoyed this episode, drop a comment or take the episode poll. Be sure to follow my guest Shivam on X at Shivam Kashan. That is SHIVAM KASHAN. Join me next month when I'll be doing my first ever portfolio review.